Hello everyone. This is Ryan Mallory for SharePlanner.com. Today is November 6th, 2014. Doing another Google Hangout with you guys, and getting more consistent. Want to at least make these things a weekly ordeal. I've tried to figure out how to do more of these Google Hangouts. Maybe do it in the pre-market or aftermarket or in the evening. I don't know. Right now, I know that people do tend to like it in the middle of the market day like this, especially when markets are fairly calm and going in the right direction for our trades. Bear with me a little bit. I've been dealing with this nasty cough. Not sick or anything, just get this tick out of my throat and constantly coughing, and it's made my voice a little bit raspy in recent days. So hopefully my voice doesn't sound too much like sandpaper when you're listening to me in this Google Hangout. So let's go ahead and just jump right into the index here. The S&P 500. It's really hard to do technical analysis on it right now. One, we're at all-time highs, so there's not really any prior resistance levels that we need to be watching. I know some people can do Fibonacci retracements and stuff like that, and that has its use and all. But honestly, the market's not going to pay too much attention to any of those things at this point. It's just going to run as high as it wants at this point. And the biggest thing that you really need to be watching is this 5-day moving average. You can see it here. It's this yellow line. The market has not broken it once, not even once, during this incredible bounce off of the October 15th lows. Now, it has gone down and below it, let's see, a couple of times from an intraday standpoint, though most recent one being on Tuesday. But the dip buyers use this 5-day moving average to go ahead and buy up the market. And until we close below that 5-day moving average, I don't see a reason to get bearish on this market at all. So right now I'm 80% long cash to still deploy if necessary. I'm usually pretty happy about having anywhere between 5 to 7 positions at a time in this market. So I may still add another position, probably not today, but in the days ahead, try to push my exposure up to 80% as far as I want to take it, especially with us having rallied over 200 points at this point. I mean, we're up 208 points off of the 10-15 lows. So we haven't even been trading a full month, and that's how much the market has rallied. So over 10%. So 5-day moving average, that's really the barometer you want to be looking at. Now, when you look at the RUD, it's a different story. It's not near as bullish, but it has broken this downtrend off of the July highs. So that's a huge development for it. But it's still just, I hate to say this because it can be discouraging in a sense, but it's really just range bound in this box that I've been trading. It broke below it, and that looked pretty rough for the market. But when you really break down the Russell, it just hasn't been able to break above the, let's see, what is it, 1212. So I mean, it still has a lot of room to go. It may eventually get there. On another note, from a short-term note, you have this bull flag that's been working in the last 5 days, and if it gets back above 1, which that's only 3 points for the Russell, it could see some additional buying power come back into it. But it's made a good bet, and made just looking at it from what it's done year to date, it hasn't gone anywhere. So yeah, I think that the Russell could start falling back down again, and the other indices keep moving higher, because that's what we saw for a good portion of the year so far. And so I think that could happen again with the Russell. So I want to I have less indices, because for most of this year, what we have seen is the small cap struggle and the large caps rally. When you look at the Dow, way out there to new all-time highs. I mean, that's been a pretty impressive excuse me, a pretty impressive rally for the Dow. And then you also have, and a lot of the Dow rally, I mean, you had one time where I think it was IBM that had the big earnings, and it just, or no, it was Visa. It was Visa that was responsible for like 150 of like 200 plus points that the Dow made on a particular day. It was last week, but I mean, so because the Dow's price weighted, it does get a little bit manipulated when one of its bigger stocks like an IBM or a Visa, excuse me, makes a huge earnings beat. The NASDAQ, this cough is about to kill me. Bull flag, similar to what the bull flag in the Russell looks like. It shows good signs of probably wanting to break. Excuse me. If I can't keep talking here, man, I might have to cut this sucker short. But you have about 11 points to go on the NASDAQ before it could really start seeing additional buying power flood that particular index too. And I've tried to add a few tech stocks to my portfolio in recent days. Or we have INFY. This one's been doing great. I bought this on 1028, alerted subscribers on 1028 at the same time, got in at 67.85, and right now we're up about 8.5% on this trade. So it's done really good. I mean, considering the price move, you know, my original reason for getting on it was just basing right here at the previous support, and it held that support really well. And when it started breaking out right there on 1028, this is where I got long. And since then, it's never looked back. I mean, 1, 2, 3, 4, 5, 6, 7 straight days. It's held that 5-day moving average. So until it gives me a reason to sell it, I'm not going to sell it. The other tech stock that I have is Xilinx, and it's not really doing too great. Right now, we're only up about 0.25%. Just got into this yesterday. But there's some nice consolidation here of late. The candle looked much better yesterday. Today, the candle doesn't look too hot. But, I mean, the trade setup, the reason for being in the trade hasn't been violated yet, so it's worth staying in. And, yeah, I mean, this one's really just like a wait and see. We haven't really moved much off of the entry price, so it's just trying to show some patience, see how the future days and future candles develop to see where the stock ultimately wants to go. Skipping around here in the portfolio, one of our older pickups still is Morgan Stanley. Bought it on 1029. It's doing fabulous today. This is the stock that I really wanted to see kick it into a higher gear, and it's starting to show that a little bit by breaking out of this consolidation today. And you know, like what we did with INFY, I just want to ride this thing up, see if we can get into the 36s before even considering trying to trim our position or close out our position on this one. The golden child in the portfolio is LUV. Huge day in it right now. 3.3% for us today, almost 9% in gains overall. This stock, we got in on it on 11.3. Everyone was alerted to it. Got in at 34.94, consolidated very nicely, and when it was breaking out, that's when we got in. And since then, we've had about 4 days of just solid growth in this stock. So, like I do with a lot of winners, I want to give this thing as much opportunity to run wild. I do realize that a spike in oil prices could hurt LUV, and that's definitely in the back of my mind. But trying to predict the price movements in oil right now is nearly impossible. So while it stays down, just continue to ride LUV higher. Next one, PHM. This one has been a little bit back and forth for us. We were actually down in it coming into today. However, it is definitely turned the corner for us and is doing exactly what I hoped it would do. It's taken a lot of patience, especially on the that we got out of it on Tuesday, when it just looked like it might try to resume this downtrend. I held it another night because I didn't think the trade setup itself was broken. And as a result, we're being rewarded for that today. It's breaking out of this bull flag pattern. It's a beautiful bull flag pattern. It's breaking out of it, and it's breaking above the down channel that it's been stuck in since, I don't know, February of this year. And so now you got the opportunity to see this thing push right up into the 20s in the week ahead. CAR. CAR, we got into this one yesterday. So far, so good. You know, it's testing that 50-day moving average, and one of the things that worries me about this trade is the almost near test of the 50-day on the 30th of October, and then it retracted some. So I'm hoping we don't get that same kind of thing from it today or tomorrow. It's going to be important to get some follow through on CAR and push through that 50-day moving average, because you can even see from a support standpoint over the recent months going back into August, it held that 50-day moving average for a while until the market finally gave way in September. So CAR, definitely want to continue to keep a close eye on it to see if there's like any kind of rejection at that 50-day moving average. If there is, we got in at 56, 57, then, you know, we'll have to take our 1.5% in gains. It's not a lot because we just got into it yesterday. And then today's edition, which has done pretty good for us so far, is HUN. It's a chemicals company. I don't know too much about the company itself, and but the setup, it's good. I've tracked this stock for years. From a technical standpoint, it's breaking out today. If I could have had it, ideally, I would have liked to have gone in at 24.60, but the trade setup was still valid, so I got in at 24.73. Right now, up about 1% so far on the day with that stock. November is shaping up to be pretty good. We've had a couple of trades that didn't play out as well as I would have liked. First one being, so far this month, Splunk, SPLK. It's a hard trade, and I was explaining to the members yesterday why I got into it. Rarely do you find a really good risk reward in a trade like SPLK. Why is that? Because it's so volatile. It has a high beta, and it can make moves of 5 to 10% in a day. However, I mean, it doesn't do that every day, but it's not surprising when it does. So we get in at this entry on Tuesday. It looks pretty good around the 64.30 area. We come away on the day with a little bit of profit in the back pocket, but we're still holding overnight. Wednesday, yesterday, it gaps up really nice, but then it gaps and craps, and it stinks. We got excuse me, we got stopped out of this sucker, and that wasn't no fun. That was like a I think it was like 2.3% loss. I can't remember exactly offhand, but it stunk. And you see it, then it gaps up today 2%. But you can see even though it's trading higher than where we got stopped out, the chart itself isn't playing very healthy. But if you just look at when we got in on Tuesday, you can see why I got in. It was holding on to that 10-day moving average. It bounced off of it. It offered a very low risk, and if I was right on this trade, my gosh, I mean, this thing is a stock that can move into the 70s with very little to no effort. And as a result, I want to be long on that particular stock, because there's the risk reward opportunity on an SPLK is like 10 to 15 to 1. I mean, it can really pay huge dividends. So in the rare cases where I can go in with like a 2.5% stop loss, I'm going to do that every time and not even think twice about it. Yeah, there's a high chance that I could get freakishly stopped out, or it gaps and craps like it did yesterday and we get stopped out. But at the end of the day, if you know that you can play it with a tight risk, like I don't have to risk 10 or 15% on the trade, and instead I can risk 2.5%, and then I can get a possible 15, 20, 25% return on it over a period of 1 to 2 weeks, then that, or less, then that is a really good trade opportunity and something that I want to take advantage of. Now, 3 out of 4 trades might not ever work out, but you got to take them, because when they do work out, man, it's well worth it. I mean, that's essentially what we did with UPRO when this market was trying to bottom out here. I mean, this was a candle that you had to play, and we played UPRO. I think we lost 2 or 3 times on it before we finally got it right. I think we lost on UPRO twice, and then finally it took off and we made our money on it. In fact, if we would have held it even longer, the gains would have been just absolutely sickening. But I don't think anybody expected the S&P to go from 1015 to current day up over 210 points or whatever it is right now. So you know, sometimes when the risk the risk reward ratio is so favorable to the reward side, yes, sometimes you got to play it multiple times and you'll get stopped out, you know. But if the risk reward ratio remains the same, you gotta play it. So SPLK, yeah, we got stopped out of it. It stinks. I don't like it, but you know, it was worth trading, and even if it did result in a loss. And then Netflix was one that we got in on 1031. The breakout looked really good, and then it just petered out on us. We got in when it was starting to break out at around 387, 388, I think, and then you know, the breakout looked really good. I was really optimistic going into this week about it, and it gapped a little bit higher on Monday. But as we all know, it's just sort of given out. So I closed out the position around 377. Yeah, it's about $4 or $5 higher from there. But I mean, the trade setup's not there anymore. I mean, it needs to make some improvements before I can reconsider getting back in. But Netflix, not to the same degree as SPLK, but Netflix is another stock that can pay handsomely, and you got this huge gap up to 420 that can be played. So if it does set up again in the coming days, I'll take another stab at this thing. I don't care. But the risk has to be tight enough, and the reward has to be great enough to where it's worth trading. And go ahead and take a look at some other trade setups that I'm watching. JNS is one that's pretty attractive. The day has not been too great to it, so that's why I've held off of getting in this stock. I had originally wanted to get in around 1481, but you can see it's 5 cents less than that. And it's just not behaving right. So, but what I like about it is you had this downtrend that was broken. It consolidated just above the downtrend, and now if it can get back above that $15 level, the notion would be that this thing can rally into the mid 16s before really seeing any significant profit taking. Then you have F. It looks good. This was another trade that I almost made today. Instead, I chose HUN, and I'm glad I'm in HUN. But F and GM have similar moves today. The one in GM being just a slight bit bigger. But F, it looks really good. I mean, you can see one candle today is wiping out 1, 2, 3, 4, 5, maybe not that one, but the last 4 days of pricing is engulfed in 1 day of F. So I mean, that's a pretty bullish move. It's outside of the norm of what we've seen of late in this consolidation pattern. It's breaking higher. In fact, I like F more right now than I did earlier this morning. I think if you trade it, when I was looking at it, it was like 1408, so it's improved by about 10 cents there. 1366, just doing the math off the top of my head, I don't know if that's the best risk reward ratio. You're probably pushing towards the 4% level, but you could probably do, let's zoom in here a little bit further, you could probably do excuse me, holy cow, these coughs are brutal. At night, these coughs really tick up get pretty insane. I feel like bashing my head up against the wall when they get like that, but hopefully it passes in the next few days. You could possibly trade this one with a stop below the lows of the day. I mean, frankly, F, if this thing retracts tomorrow and it gets below 1392, do you really want to be holding it at that point? I mean, the trade would be broken for sure. So I don't see any reason why to put a stop loss less than 1390. So, and then AVNR, that's not it. I was going to say that trade setup looks a lot different than when I was looking at it earlier. But yeah, AVNR, and a lot of problems with this one is I was going to have to risk closer to 4%, whereas with HUN I could risk far less. So AVNR, I mean, you could probably get in and even push the stop up to 1282 if you wanted to. Ideally, though, I would probably want to put this stop loss right around 1258 or so. that was the problem. So I was hoping that maybe we could get a little bit of a pullback in it, but it doesn't look like that's happening. So you might have to do like the 1286 if you want to trade that stock. All right, some of the bigger companies, AAPL, Apple. You actually have a nice little consolidation going on here. We traded it from like 96 to, I can't remember what the exact price was, but we made some nice coin off of this trade. And we wrote it up for most of this rally here. I think we got out on 1030. But now it's consolidating a little bit. It is below the 5-day moving average, but I think there's a lot of interest still on the street, which you can see by the long shadows underneath the candles. It shows that when the stock drops, it gets bought up and it doesn't close at the lows of the day. I mean, every time it's dropped, it's done that. So there's a lot of people still buying the stock, still interested in seeing this thing go higher. So I think you can trade this thing. And the good thing about Apple is you can get away with like a 2.5–3% stop loss, and if that thing triggers that far below, then something's definitely changed on Apple. So Apple's been one of my favorite stocks to trade simply because the risk reward ratio is always favorable when it does set up. So I think you could trade this with a stop loss at like 105.88. If you're getting in at 108.36, so you're talking about what, 2.5% or so. And yeah, just a really solid setup. So I'll probably watch Apple tomorrow. You know, especially if I want to go up to 80%, that might be the stock that I would want to push it up higher with 80%. I don't really want to stick in some crazy biotech or anything in the portfolio to go up to 80% on the in terms of how much exposure to the long side that I have. GOOG, I would stay away from. Gee whiz. GOOG. This stock just looks like it's got problems. You know, for whatever reasons, it tested. You can see I mark up this stock all the time. I gotta stop doing that. Because it, you know, for me it doesn't bother me, but if you guys are looking at this thing, you're like, goodness gracious, what the heck is he doing to this stock? One of the things I'm not a huge fan of is when people post charts and there's just a bazillion lines all over it, and you can't tell what the heck they're even looking at. Simple and easy, man. That's what I want my charts. But you can see here, this area here was sort of like a neckline for this breakdown, for this distribution pattern. And when it broke below there, that's when, you know, all havoc broke loose on the stock. It goes way down to 510, and then it bounces up, but it bounces right back up to that neckline, and then it sells right back off again. So this stock is very bearish in my opinion. I would not be buying this stock at all. Netflix. Oh, we already talked about Netflix. Facebook and Twitter. I'll do these things really quick, but these stocks seem like they're borderline directionless. Between the two, I'd say maybe Facebook has a chance of either going significantly higher or significantly lower just because it's in this consolidation area. So if it breaks below 73.68, maybe that's a short opportunity. But I would probably only play Facebook right now to the long side. So if it breaks 76.70, that might be your cue to get long. It would be breaking above some moving averages here, and you know, be going into that gap from its earnings when it missed. So I think Facebook. I think there's some definite value in Facebook if it can get above that 76.70 level. All right, what am I forgetting here? Oh well, since I did Facebook, let's do Twitter. Twitter, I just don't see anything about it. It's stuck in this gap right here, and I don't know what it intends to do. Are you going to fill it at 38.90s, or are you just going to go back up and try to fill this gap? I can't tell you. So yeah, if you're desperate to trade some social media, I'd probably look at Facebook and use the parameters that I told you to use. And that's going to do it for today. I don't know how long I went, but I'm just glad my voice held up. And you know, it's been a great November so far. We've had a couple of trades that didn't work out too well, but overall the portfolio is looking pretty green for November already. And we just finished a great October. So if you're looking to subscribe to the Share Planner Splash Zone, I highly encourage you to do it. You can go there to shareplanner.com/splash zone. Let me say that again, shareplanner.com/splash zone. And you can get all the information for there, sign up from there. And I'm in the chat room every day, man. I don't even know when I'll take a vacation, but I just don't seem like I ever do. But yeah, you can sign up there and ask me questions all throughout the day. I'm in the chat room every day. I post my alerts. I send out the alerts via text, via email. If you're international, I send them to Bosnia. I send them to Czech Republic. I send them to Mexico, Canada, Andorra, England, Ireland, anywhere you can imagine. These are every continent besides Antarctica, because I think Antarctica does not have Wi-Fi yet. So yeah, I don't know if the Eskimos are really plugged in down there. So anyways, it's been great talking with you all. I hope you've learned something from it. And if you ever have any questions, email me, ryan@shareplanner.com. I'm a little bit behind on my emails right now, but I plan on getting caught up with all that tonight. So if you email me today, you'll probably get something tonight from me. Otherwise, have a great weekend and God bless.